Is the 60/40 portfolio dead?
Is it dead? I'm not sure when it was last alive, actually. Look, in my mind, it's dead, buried, forgotten. Probably a little while ago. I guess, look, a lot of the investors I work with very much think about portfolios broken down into at least 3 buckets of equities, fixed income, and alternatives. Once you start getting into that alternatives bucket, you then break that down into, you could have 20 other buckets under there. So really, how I think of it, absolutely the traditional 60/40. There's plenty of reasons for this. We can come on to them. But yeah, there's more going on in the world. There's more dimensions to how allocators can invest than there were historically when all the research was done on, this is, efficient frontiers and this is what a 60/40 should look like and this is what you get. So yeah, very much dead.
Nice. Gone and forgotten.
And when we were researching for this interview, we saw some Franklin Templeton research that suggested that now is a pretty pivotal moment in adoption of alternatives in private markets. What's some of the research and some of the data that sort of says that now is the time?
Yeah, we absolutely think that. Number of really key drivers. I guess part of it is the economic environment we're in. We're in a higher rate environment than we've been in for kind of 20 odd years. We're in a higher inflationary environment than we've been in. Therefore, we're dealing with different economic scenarios that affect our portfolios differently to what they have been in the kind of broadly the last kind of 20-year period since the GFC. So that's one thing. There's a big part around geopolitics and all of the noise that's going on there, creating a huge amount of volatility and uncertainty in markets. Volatility and uncertainty are really bad for kind of traditional directional strategies. So things like, just your traditional equities. If you don't know what direction things are going in, you're making a pretty big bet to go this way or that. Within alternatives, within liquid alternatives, hedge funds type strategies, you've got many levers to pull, so you can actually bet on winners and losers, and you can win on both sides. So you don't need to know the directionality. You can play a more kind of market neutral game. So I think on that liquid alternatives hedge fund side, it just makes total sense when you've got volatile, uncertain markets. I think on the private market side, part of the reason why we would say that now is a really opportune time is partly just because there are now available options to invest in private markets outside of your traditional players who would have been your institutional investors or really large allocators who would traditionally have played there. So there's just more product structure. There's been a lot of evolution in building structures around private market strategies that make them more accessible to a broader audience, and particularly a kind of in the Australian market, a wholesale audience. So I think that's really key. I think also just how, alternatives have become so much more mainstream. I think there's so much more familiarity with alternatives, whether they're hedge funds, liquid alternatives or private market alternatives. So I think that educational process that's been long and slow is finally getting there, and I think the recognition that to build a really diversified, robust, resilient portfolio, you have to have more drivers than your equity, essentially, relying on your equity risk.
Yeah. You say the education process has been long and slow, but I imagine that, some of the returns that particularly private equity has been generating, over the last decade, call it, has accelerated the educational process.
Yep.
How has the conversation with advisors changed from, say, a decade ago to now when you start talking about alternatives?
Yeah, absolutely. And private equity over the last 10 years has returned around kind of 16% per annum. That's about the level that we're looking at. So, that's a really significant return. If we think about private equity, you've used that example, let's use private equity. In days gone by, companies would, they'd start off as private companies. They'd grow to a certain scale, and then they would get themselves listed. That would be, that's their big kind of, we need to get to listing. That's when we get our payday. And then they drop into all the indices and become a kind of public market, part of the public markets. What we've seen over the last 5 or 10 years is companies going public a lot later, or not going, really holding off going public. And there's a bunch of reasons for that. primarily just access to capital for private companies has been really easy to come by, and this is partly due to the amount of money, particularly from institutional investors, that has flowed into private equity. So there's been plenty of money for them, plenty of investment for them. They haven't had to go to the public markets to get that investment. And then, of course, there's regulation complexity is only going in one direction. So if you're a public company and you can, report to your group, you have proper structures there, but you are not having to do the reporting to market, the board packs, the scrutiny, the short-termism that you get from the public market, just means that those companies are staying private for a lot longer. So back to the original question, I've gone a bit off track, but I think 10 years ago, investors may well have been investing in some of these private markets. They just happened to be public at that point. Now they're saying private for longer, so now you actually have to go into a different vehicle. You can't get that access through your public equity exposure. So that's part of it. And then I guess, the other part is just familiarity. And I think part of that is just how the world has evolved and how much access all of us now have, podcasts like this, to be able to educate ourselves and understand markets beyond just, the ASX 100, the ASX 200. Like, we actually have an interest and a knowledge of much broader. So I think that's, an interest, really. I think that's been really, part of the kind of progression.